All right. So it seems like it's been forever since we've had a lecture here, since we had the test and then we had spring break, and now we're coming back. So I have the test that we're going to run through just to make sure everybody understands everything. I think it was fairly straightforward. There weren't meant to be any trick questions on there. If you do have problems with questions or different interpretations and you think you've got a valid point, you can always email me and see if we can hash it out. The important part is that you understand, what's at what the concepts are. So opportunity cost pretty straightforward. It's hopefully you'll get to a point in life where you have enough money where you're investing and you're able to do stuff and you're not living from paycheck to paycheck and all the rest of that. And the only way to get there is to build up some cash. And so I realize, it's tough, wages, everything else, but you have to do what you can. You have to be even more, disciplined in terms of opportunity cost. You have to recognize when something's a necessity and something's not. And so, if you splurge on something financially, that's not a good habit. I had I only have one ex-spouse, but my God, she did some retail therapy, and it was just not a good coping strategy because I don't think she felt any better afterwards, and certainly diminished finances. So, if you do have that issue, uh, work on it. Maybe come up with something else. What you're following, another opportunity cost. So, giving up on a movie in order to study for your finance exam. So it can be time, it can be money, it can be lots of things. When you're doing one thing, you're not doing something else. Again, you don't want to end up, completely boring person. You do want to have some fun, especially, for your mental health's sake and the rest of it. But, try to eliminate things that don't add value to your life or to your pocketbook. So anyway, retirement planning, start as soon as possible. And again, we'll talk more in the investing. This isn't all about, I'm putting this money away for 50, 60 years from now. I have found ways numerous times I've started businesses and taken out loans and finance things by borrowing against my retirement savings. And the fact that it's in my retirement rather than just normal savings meant that when I put it away, it was tax advantaged or it was matched by my employer or something like that. So, I call it retirement planning. But truth is, if you need to pull the money out, well, if you just want to borrow against it, that's completely painless. There are no fees. If you're in a bad situation, well, then generally we'll go through the exceptions, but you can generally get a hardship withdrawal from that retirement without, the penalties. Or if you're just going to suck it up and pay the penalties, it's going to be 10% right off the top. Plus, that income is going to be added to your existing income, but, that's kind of the way it works. But anyway, you can get at that money, but make sure that's a conscious decision. Anytime you have money in an IRA account, make sure an IRA, a 401k, some sort of tax deferred thing. We'll talk more about this later, but if you're switching from account to account, it needs to be rolled over, not withdrawn. If you get a check that says whatever your name is directly, you just generated a taxable event, probably some penalties as well. That's fine if that's what you intended to do, but if you just did it out of buffoonery or buffoonery on the part of the company who cut you the check, you need to get that corrected because it does make a difference. Anyway, not quite on the test, but something to keep thinking about. Expending exceeds the amount of your income, best option. Yeah, the only way you can get around this, the only long-term solution, is to reduce your spending. Liquid assets. So liquid assets are cash. Things that can be converted into cash quickly. So obviously cash is already there. So that's why cash is a great liquid asset. The exception to this is real estate. Real estate is not liquid. Real estate transactions are slow. And so it's just, you don't have good cash flow if you're just holding real estate. Car loans, all these things. You know from the definitions that if it's over a year, it's long term. If it's less than a year, it's short term. Well, student loans, car loans, housing loans, those are all greater than a year, so they're in the long term category. Current liabilities is kind of synonymous with short term, not a term we use, more of a financial term. Personal obligations, that's just a throwaway. So, anyway, best measure of your wealth is your net worth, assets minus liabilities. If you got a bunch of stuff, but you've got a bunch of bills, especially if it's, depreciating assets, you're not in good financial shape. Your net worth is negative because you probably are underwater in the majority of things. And likewise, if you've got a huge house, but you've got a huge loan on it, you may be in decent financial shape because that house is appreciating and you're controlling it and all that rest of it. But if you do an examination of your net worth, you don't count that entire house as your asset because there's a huge loan outstanding on it. So, fair enough. Why is it important to monitor debt level? So you maintain enough so it does not become so high that you cannot cover the monthly payment. So again, this gets back to liquidity and everything else. You need to live within your means, or any other way we can say this, but you need to monitor the debt level. Money today is worth more than the same amount of money received in the future. That is because money today can grow at a compounded rate. So inherent in this question, or whatever, the answer here is that you're going to invest that money. Now, if you're just going to sit on it in cash, or basically sit on it in cash by having it in a savings account that doesn't pay squat, this doesn't work. Compounded rate means that compounded means the interest earns interest, but you've got to exceed inflation rate. So I did have a student who had a question on this, and she kind of had a point, but it's assumed that you're not going to sit on your money, that you're going to do something with it, invest it, and do a little bit better. Again, inflation is high again right now. The reports are coming out. So, but hopefully this is a temporary financial / political situation that will go away. And anyway, in a normal thing, they're actually shooting for 2 to 3% inflation rate is what's supposed to be normal. And that's not where we're at right now. So, anyway, if somebody gives you money today, you would, and if you're smart about it, you would want it today, and you would invest it wisely, and therefore it would be worth more in the future. Same thing about time value of money in this next one. $1 today is worth more than $1 received tomorrow, because you put it in something, and it earned interest, and now it's grown. Earning interest over time is compounding. So 3 questions in a row basically on interest. Totally different subject. Head of household. So head of household is somebody who's, in taxes, obviously you want to pay the least amount possible. When you put single on the tax form, your taxes are going to be the highest. If you're making $100,000 as a single person, your taxes are going to be considerably higher than a married couple with $100,000 combined, because you're just one person. You don't have the dependents and yada yada. That's the way the tax code's written. Now, if you are single but you do have dependents, but you're just not, in the formal institution of marriage or whatever, you can check head of household. So, and again, if there's some sort of divorce involved, one person can claim the dependent. A dependent can't be claimed by multiple people as head of household. So somehow that needs to be sorted out. But anyway, head of household is where you want to be if you're a single person with the dependent, because it will lower your tax rate. Here's a simple math problem. 7 years ago, so it's long term. She $20,000, sold it for 5, so she made 15 grand. And so right here, first one, 15,000 long term, easy. Purchasing will help reduce your tax bill. So of all these different types of loans, all these things are consumer loans, except this one category here is a real estate mortgage, right, for a home. And real estate is the one that you live in is tax deductible. Actually, if you have a rental property, it's tax deductible as well, but that's a different category. But of all these different loans, the one that stands out in this group is the home, because again, it's treated beneficially by the tax code. Financial institutions loan funds at a higher rate. That's how they make money, right? They loan out at 8% and they pay you squat, a couple percent or 1%. So we'll talk more about investing in the long run. But again, especially right now with inflation, you need to be smart when you're investing your money, or the buying power is going to be eroded away. Your ability to cover short-term cash deficiencies is called liquidity. Again, we know the relationship between liquidity and cash. Disadvantage using a credit card for a source of liquidity is the potential finance charges. So this kind of brings us full circle. When I'm saying you need to invest your money, you need to maybe, let's say you've got 10 grand in cash, and you don't want to be stripped down. You don't want to be have nothing in terms of an emergency fund. So you get your 10,000, you put it in some sort of brokerage fund. You're not putting it in crypto. You're not putting it in something. You're not speculating with it. You're putting it in a investment that gets you a consistent, at least for this 10 grand, that's your emergency fund. You're putting in something fairly stable, but something that's paying at a rate better than inflation. Well, since it's in that brokerage thing, and let's say the car breaks down, okay, now you got to transfer from the brokerage. Yeah, a couple, 3 days, maybe 2 weeks to get it all done and get it back out of that account. It's nice to have a credit card, to throw it on the credit card. And as we know, if you pay off your credit card within that cycle, you are a convenience user. So you use their money and then get charged for it, because in the meantime, you're able to go to your brokerage, wherever you stash that 10 grand away, you're able to pull some of that out, pay off this bill, and everything's good. Credit card, they'd be happier, if you continue to bill, but they're still pretty happy because they charge the merchant 3 point whatever percent just for accepting the credit card. So anyway, there's very few emergencies in life that can't be easily handled with a credit card. Outside of whatever deals, cash is usually kind of awkward, and it's just, especially the younger generation anyway, Venmo and everything else, you're moving money around, and now Venmo's even got credit cards. But for the most part, a regular credit card is not a bad way of doing it, because at least my Venmo comes out of my checking account, so the money needs to be there. I prefer to put things on a traditional credit card, get a few miles, pay it off, and anyway, it just works out. Each to his own. Stopping a payment on a check. So this is becoming less and less relevant. One, because we don't use as many checks, and two, because checks clear so quickly now. Most checks are automatically processed, digitally processed, whatever. They don't physically. But if you can somehow, where this does become a thing, is if you have written somebody a check and the thing goes missing, lost, well, and I gave you the story where I, as the merchant, somebody had bought something from me, gave me a check, I buffooned it, I lost the stupid check. The client does not want to write me another check because they're afraid that, even though I appear honest. Anyway, they don't want to write a second check. But the solution is, okay, let's put a stop payment on this other check. That way, if that check is presented, it will not be cashed. You can write me a second check in good faith if you're a nice enough person, and that's all good. So that's what a stop payment does. And it's not used to, oh, I'm going to screw this person. If you write a bad check, you've committed a crime, basically. And even if it's, substandard goods, it gets a little murky in terms of what you've done. Again, my preference is for the credit card. Credit card, I have a few daughters. One of my daughters, she was in Atlanta and needed to take a taxi to get to a thing. She'd left her keys, yada yada. Long story, but she jumped in a taxi and took a taxi from the Atlanta airport to the Atlanta airport hotel and was charged over $100. The guy clearly ripped her off. So she called me basically in tears. I didn't cry about it. I called whoever it was, Visa, MasterCard, and said, yeah, this is fraud. Boom. They don't pay. They put it in dispute. So it's a lot cleaner. And sure enough, the guy was a crook. I'm lucky she didn't get hurt because the taxi driver's certificate or whatever was deceased. It was a fraudulent whole scam thing that she walked into. But financially, it was easy to get done because of the credit card. The fact that credit cards, as a merchant, it takes about 3 days before I actually get the money. And if you call, if you had this bogus cab ride and you call that day, the credit card company has no problem suspending that payment because they haven't paid anybody yet. They're not out any money. They just turn that payment off. And so it's, if she would have paid in cash, she would have been screwed. If she would have used a check, well, he probably wouldn't have taken it. But let's say you're in that situation, it's more awkward. With a credit card, dead easy, done. Anyway, arrangement that protects customer writes a check or uses a debit card for an amount that exceeds. That's overdraft protection. Accidents happen. It will happen to the best of us. And I don't want to say you want this to happen, but again, if you're the kind of person who, I keep an extra 5-10 grand in my checking account so I never bounce a check, that's not a good strategy. Your money's at risk in that checking account. I mean, that's if you're going to have some whatever identity theft, that's probably where it's going to occur. Plus, you're not getting jack for interest or anything on that. Your money should be invested. You should kind of max perform that checking account and not run it razor thin, but you should not have a ton of excess funds in there. Those should be in another account that's earning whatever. You can easily in super safe investments get 5-6%, 8% interest. And so do that. Do not. So again, when you're doing that with a checking account, once in a while, somebody will sit on a check or you'll lose track, and all of a sudden this check pops in your account, and boom, overdraft. And if you don't have overdraft protection, it gets quite painful. All the little charges add up, and you can't say anything about it because you're in the wrong. So don't put yourself in that situation. Overdraft protection, it rolls onto a credit card or whatever other account you have, and there are no fees involved in that situation. All of the following situations are valid reasons to borrow funds except day-to-day expenses. If you're continually borrowing money, medical emergencies, yes, that's going to happen and put you, in the hurt locker. College education, that's, hopefully an investment. Hopefully you're getting something useful that you're going to pursue, and it's, it's an investment in yourself. Purchasing a car in order, you got to get to work. But if you're just struggling to put, anyway, something's got to give because you can't do that long term. Hopefully you won't find yourself in that situation. Paying credit cards, wise to pay off the balance. Exactly. The interest rates are extremely high. I think I shared that video with you about these states, states that may or may not have a whole lot going on, maybe South Dakota's trying to steal Delaware's thunder now in terms of being the most credit card friendly, not friendly to you, but friendly to the credit card company, where they can charge, interest rates in the high 20s. I mean, that stuff adds up in a hurry. Don't let that happen. Be a convenience user. Which of the following is not true? Okay. So they're treated just like others. No, they are not. There's going to be a charge, typically, a use charge, and then there is no grace period. They start charging you interest from day one. So, transaction fee, interest. Yep. Whoops. Emergency funds, we talked about this. But yeah, they're a horrible place to take a loan. And in fact, if you get behind in your credit cards, own up to it. Don't call some credit card help thing, that you saw on the internet. Call the Visa or MasterCard, whoever issued the card, and say, look, I got a problem here. I'm not going to be able to pay any more than the minimum balance for a while. And I need something. So, they have options. They want their money, and you want to pay them off. You don't want to make your financial situation any worse, damage your credit, and they don't want you to declare bankruptcy or do something, drastic. So maybe they put it in a different loan. Maybe they, if they put it in a loan with fixed payments, they can give you a lower interest rate. You can get away from those high interest rates, but you got to let them know. You got to work with them. They have their own little credit counseling thing, of organization. I'm not saying they're, completely your friends, but they're a much better solution than somebody online who's telling you can walk away from it. And oh, by the way, they want a fee to explain to you how you're going to, leave these people on the hook, because credit card companies, they're pretty smart. They're not going to be left on the hook. It's like all these scams that say, oh, you don't have to pay income taxes. Ooh, believe me, you do. There's a number of folks who have found out that, anyway, yeah, the IRS can come after you quite easily and will, and you're guilty. Anyway, finance charges apply only to balance for not paying full. That's true. APR, annual percentage rate. Good practice. So this all gets back to what I was talking about. If you contact the credit card company, now with all their algorithms and everything else, and they're tracking you on your phone, and they know where the charges are coming from in a strange place. Anyway, they spend a lot of time, so they may be the ones to alert you for fraud, but you may catch it yourself. But anyway, timeliness is the issue. If you let it go a week, that's not good. If you let it go a month, that's really not good, because now, there may be things in their rules that say they don't have to reimburse you. If it's within a month by law, they generally have to take care of it, and refund the charges. If you let it go more than a month, now you're outside of the legal limits and you got problems. Collateral. Collateral is what you want. If you're going to get a loan, you want something named that is the collateral, the security that is going to make the lender comfortable. If the lender is not comfortable, they'll increase the interest rate on you until they feel comfortable. They're gonna, if they don't have a good asset, a good sense of security on the loan, then they're going to up the interest rate on you. So it's in your best interest to not have, say, a signature loan or financing a big purchase on a credit card and paying it off that way. No, you're better off, having something named. Now again, there's certain Lowe's and Home Depot, and probably there's other stores. That's just some of the ones I deal with, where they'll have, no payments for 2 years or whatever. And plus they'll give you 10-15% off on that first day's purchase if you sign up with their credit card. If you're buying an appliance, it's not a bad way to go. And I do it continually. I don't have a Home Depot card right now because I'm not going to buy anything right now. I get it. I make whatever payments, but I usually just pay it off. But I'm more interested in that 15% or whatever they're going to give me that first day. And then I cancel the card because I don't want an open credit card, because I want to get the new guy special, 6 months, a year from now when I need something again. And believe me, they'll keep doing it. I've gotten and canceled the Home Depot credit card and the Lowe's credit card probably a dozen times now. And whatever, it's just the game. But you have to not be a current customer or you're not eligible. So maybe a little extra effort, but sometimes if you're making a major purchase, it can be helpful. Big flooring purchase or a big, appliances generally, it can save you a few dollars. Which kind of loan generally charges low interest rate? Again, the secured one, secured, collateral. All those terms refer to the same thing. Cosigner. So somebody else had a question on this as well. So the big picture is, don't get into a co-signing agreement almost without exception. I mean, if your best friend or someone in your family needs you as a co-signer, maybe loan them the money directly. Because the problem with co-signing is, if things go wrong, the person who needs a co-signer doesn't have, in the view of the lender, does not have the financial assets to back up this loan. The lender is saying, nah, this person is getting in over their head. And so they've come to you to be the co-signer because you have good credit. So again, the worst case scenario is this thing goes to collection and the lender, or, dog the bounty hunter, whoever it ends up with, the person who gets this loan in the end, they're not even going to bother with the person who needed the co-signer. They're going after the co-signer because he's the one with the assets. Time is money. They're not going to waste time trying to get money out of somebody who doesn't have it. But that co-signer obviously had it. That's why the loan was granted, based on the financial strength of that co-signer. So anyway, and they will, seize the assets. They'll do whatever they want because you signed on the loan for a debt that hasn't been paid. So they'll take your stuff. The person who originated the loan probably doesn't have good stuff. You probably have better stuff. So anyway, just avoid it. When purchasing a home, the real estate commission is paid by the seller. So again, we'll talk more about real estate stuff. I'm not shilling for these guys, but believe me, some of the worst deals out there are for sale by owners because they're frustrated folks and they're not, they're only selling one home in their life or two homes in their lives. And if they cheat somebody a little bit, a real estate person, if they end up in court, they're going to lose. They don't want to commit any sort of non-disclosure. They want to make sure everything's done properly and legally and the rest of it. So anyway, that's a good agent, not, just anybody, but you're not going to hire just anybody. Disadvantage of a homeowners association. Man, I could go off on this. I'm not a fan, but again, I don't live in a dense community. If I lived in a dense community, maybe I would be. I don't have, I live in the Butte. There's people, my neighbor, my God, he shoots his gun a lot. And God bless him. I love when he makes more noise than I do. But certain things don't bug me. Depends on your situation. But I do have a friend who was a tree counter down in Eagle River, and he'd come by to people's homes, and if they didn't have 3 trees in their yard, who cares if the moose just ate it? You still need 3 trees, and if you don't, you're going to get a little citation, and it's just like, anyway, life's too short. I don't want neighbors that close. Fixed rate mortgage, the payments stay the same forever, for the term of the loan. It's a beautiful thing. A 30-year mortgage. Think about that. 30 years. Some of you haven't even been on this planet 30 years, and you can imagine how trivial that mortgage payment is going to be 30 years from now. So it's maybe a tougher thing to pay right now, but it goes down. Whereas rent is indexed to inflation, so it's just going to continually go up. ARM, adjustable rate mortgage. We'll discuss this in real estate stuff, but yep, it's I mentioned some of these different loan packages where interest rates are indexed and they can change and go up slightly. Typically, they have a lower interest rate, but there's a bit of a gamble involved here. But if you need to get in on the property, and I don't know, it depends on the stability of the financial times. Prior to 2007, 2008, the big real estate meltdown, quite popular. Post that period, not as popular. Anyway, ignoring risk. Yeah, you just can't bury your head in the sand and, I hope this just doesn't happen. I mean, you're not even hoping this doesn't happen. You're just ignoring it. You're just pretending it's not going to happen. And that's not it. Avoiding risk means, okay, basically all you can do is, avoiding risk is quite difficult. You can mitigate risk, you can reduce risk, you can wear seatbelts, you cannot drive like an idiot. But to completely avoid it, if you're out on the road especially, you're exposed to other folks. Accepting the risk, you can say, yep, if this happens, I'm going to cover it, State of Alaska does that. You can do a self-insurance thing yourself. Again, this isn't just a do-it-yourself thing. You got to work with the DMV to find out what sets their legal requirements, and you'll have to, post a bond and do all this stuff. But you can do it. Insuring against risk, the most common thing. Have somebody else, accept that risk. But, of course, they're going to be all about, they're making you, want to avoid risks. Don't drink and drive. Don't do this. Don't do that. And they're going to penalize you with higher premiums if you do not avoid the risks the way they want. Comprehensive. Comprehensive is the cats and dogs stuff, right? It's everything else, cars in the garage, and, well, now we get in the thing, is it homeowner's insurance or is it the vehicle insurance? Anyway, but yeah, windshields, all that other stuff comes under comprehensive. Collision is what happens when you're at fault and you don't have any insurance and you just got to suck it up. If you have collision coverage, then you're still covered. If you don't have collision, then it's all on you. Liability coverage, that's the basic legal requirement. That means you screwed somebody else's stuff up. You hit them, you did whatever. That's what the legal system is mainly concerned with, your actions towards somebody else. Deductible, that's the amount you got to, pay up. You have, $2,000 worth of damage with a $500 deductible. The insurance company, at most is going to cut you the check for $1,500, and the $500 was your deductible, and that's what you're going to suck up. And then standard homeowner's policy, flood insurance, right? Not an insurable condition commercially, This is taken on by the government because it happens to too many people. No commercial company could make that sort of agreement. Personal property, you should take out an additional policy. So we can call it a floater, we can call it a rider, or we can just contract addendum, whatever. You need something that delineates, lists out those items, or shows some sort of, change to the standard policy. Because the standard policy is going to say, your homeowner's policy, it's, you're protected in case of whatever peril for, $500 worth of personal electronics, and you've got, $10,000 worth. You need to let them know you've got $10,000 worth. They'll charge you increased premium, but you're covered. Best way to reduce premiums is to increase the deductible. So now you're paying, $750 or $1,000 deductible before they have to pay anything. Health insurance, since it's expensive, typically share the cost under the employer thing. So typically the cost is also lower because they bought, the employer typically bought a group policy, so that helps. And then if they're a good employer, they hopefully subsidize it. And you'll probably have to pay something, but anyway, they'll share it with you. So that's the concept there. Okay, life insurance. Life insurance, I'm not trying to wade in a controversy here, but life insurance is, I've just been watching so much stuff because I am semi-deeply involved in crypto, and there are so many scams out there. The whole world is nothing but scams in the world of crypto. And life insurance, it's more regulated, but the number of people who, do not have your best interest at heart, but act like they do, that's, kind of by definition life insurance. Life insurance, I've never met my life insurance agent. I don't want to. I don't need a life insurance agent. The type of policy I want, I don't have to have a personal relationship with them. I can buy it online. And now I'm to the point where I don't want life insurance because, as you get older, it starts to get more expensive. And if you've got, some nest egg or something built up and you're still investing, life insurance is not a good investment, Plus, the responsibilities I have if I was to check out are not what they used to be. Children are grown. House is good. I don't have a bunch of payments. I don't have a need for a huge life insurance policy. Whereas if you are a young person, if you're alone, yeah, you're in the same boat I am. You don't need life insurance policy. But if you are, have young children, you have a spouse that's maybe not fully employed, or a spouse that, the house you live in requires both incomes, you need all kinds of life insurance. But the good news is you're young, and hopefully you're healthy, and so it's cheap, not a big deal. The big problem with life insurance that makes it expensive, and it doesn't need to be expensive, is when life insurance is combined with an investment vehicle. And there's a couple of reasons. Again, I'm getting kind of opinionated here, but life insurance, I mean, the numbers are out there. They don't get the same sort of returns that pure investment vehicles do. Life insurance companies have to be very cautious, and then they also have salesmen involved in the process. I've got a brother-in-law that makes bank on commissions. And he, every time they renew that policy, he hasn't talked to these people in quite some time, but every time they renew, he gets they call it his book. He gets a commission from that original sale that he made a long time ago. Well, who's paying all those commissions? The person buying the policy. And so there's all these complex life insurance hybrid policies that are confusing, and they need to be explained by an agent, and I just don't do it. And you will find that even though I'm saying, I'm opinionated in this stance, my opinion is generally shared by most, personal finance folks who have your best interest at heart, and oh, by the way, aren't on commission. Somebody who's on commission, there's a thing called fiduciary trust, somebody who has your best interest ahead of theirs, and that's tough to do if you're getting paid a commission. So anyhow, I've probably alienated one or two folks out there who might be involved in the life insurance business, or have already started a policy like that, and yeah, it is what it is. Okay, so life insurance provides a payment to the beneficiary when they die. Pretty straightforward. Roll of life insurance. Like I said, support dependents. Leave money for heirs. That's kind of a secondary thing, but you can leave a lot more money for your heirs if you've invested wisely. But it depends, if you've had time to gain that money. If you die when you're young, it's probably going to come to them through insurance. People don't like to dwell on life insurance because, you're talking about death and all that, and people try to ignore that. And hard to pay for ongoing benefits you might not need. Meaning, the only way life insurance pays is when you die. Fair enough. Role of life insurance companies help determine the type and amount. If you go to an insurance company, oh boy, they are going to steer you towards the the better product, not the better products, the more expensive products, the ones that have the commissions and maybe are more confusing. They also should have the term life policies, the ones that are a little bit more straightforward that I'm referencing, but they're not really going to press those on you because anyway, they're simple. They don't typically need a salesman involved, and they don't have these recurring commissions. Applying for life insurance, medical and lifestyle history. So, way back when, I used to fly fighters, and so I can't remember what conflict we were going to, but it was looking kind of dicey. We'd had a few guys shot down, and I went and got three life insurance policies, all for $1 million. I wanted to be squared away. And all these questionnaires, they asked me, do you smoke? Do you scuba dive? Do you whatever? But not on one of them said, are you going to be participating in a war next week? Anyway, it wasn't on the thing. So I ended up getting all these insurance policies. And whatever. A couple months later, the conflict was over. I was back home, and I canceled the policies. Not a big deal. And these policies, though, they were cheap. We're talking, $40, $50 a month for $1 million in coverage. It was a good bet. But it did sort of put these people, they were a little concerned what exactly was going on in my life when I'm taking out all these life insurance policies. So I actually had a personal visit to the house from some lady who may or may not have been a nurse. She was dressed up like a nurse, and she drew my blood and things like that. But anyway, I was healthy, and so. But they're going to want to know a lot of things. And again, if you do smoke, that's not going to help you out. Also, this gets into the thing about personal, information. They would love to have your DNA. They'd love to be able to know what you're susceptible to and your medical history. And so you need to guard that, because if there's some negative information out there and it's in the public domain, you might find yourself uninsurable or insurable, but at a much higher rate. So be careful with that. Term life insurance. So this is, we could stop right here. This is what you, again, the only policy I've ever had, complete coverage. I was great. Anyway, term life insurance. So the reason why it's called term life insurance is because it insures you for a particular term, that term that you're paying for, and it's insurance. It's all in the name. Very easy. Premiums on a term, paid monthly, quarterly, semi-annually, however they want to do it. So, the deal is you say, I want $1 million worth of coverage, and, I want it for the next whatever number of years, because they'll normally guarantee some sort of rate, and they'll say, okay, you're young, you're healthy, we can give you $1 million worth of coverage, and we can do that for, $40 a month or something like that. And you say, good. And at the end of 10 years, you're done. You didn't die, so they didn't give you any money, and the 10 years is up, and so you're not giving them any money. There's no cash value. You don't take loans against it. The only time this thing becomes a thing is when you die. And if you didn't die, good on you. You didn't spend a lot of money. Now, the other part of term life insurance is, since you're getting such a good deal, you're only spending $40 on insurance, you should be getting that, $800 or something that you would have spent on a whole life policy. You should be getting that other money, the other $750, and putting that in your investments. So one of the big arguments, the more complex, life insurance agent, where they have a different policy, they say, oh no, this is a great deal because it forces you to save. And, sometimes I have a point for discipline, but I find it kind of insulting when they say, oh, I'm not disciplined enough to save on my own. I need you to help me out here. And oh, by the way, you're going to take 100, 200 a month out of my 750, 800 for your commission, so it's never even going to get invested. So I want no part of that. Anyway, the longer the term, the higher the premium. Yep, they're making a guarantee. You're 30 now, but if you do a 20-year term, now you're 50. Not very often do people die at 50, but more often than 30. The older the policy, this is where it gets unaffordable. People say, oh, you don't want term. When you're in your 60s, 70s, 80s, you can't get insurance. It's going to be, okay, you don't need insurance at that point. You should not need insurance at that point. You should have done what we said. You should have been investing a little bit because you're saving by buying the term life insurance, and you've got pretty good nest egg. Yep, linear, completely correlated. You want $1 million, it costs this much. You want $2 million, it costs twice as much, maybe. Higher for males and females. There's not a whole lot of female loggers, roofers, doing stupid stuff. Plus, whatever. I'm not being sexist, but males do tend to hurt themselves more often. Although that could change, But anyway, generalized, this is what they do. It's not personal. It's just based on statistics. Smokers, we beat that down. Medical problems. So they'd love to know, what's wrong with you. And anyway, so this gets in the range of unaffordable. But I don't care. I quit doing the insurance gig in here. Back here, you've got to get your spouse. You got a 30-year mortgage. You've got kids going to college. You got all sorts of responsibilities. You got to do the math and add up and see what it's going to take to get your significant other and your kids, up to a point in life, uninterrupted due to your death. There's going to be an emotional void, hopefully, but the financial void, you can fix that. You can get some insurance and get that done. But now it's a different story. You're 55. You bought the house back in here. It's almost paid off. The kids either did or did not go to college, but you're not saving for that anymore. You're probably saved some money on the side, so you've got some savings built up at this point. So, you're just in better shape with less requirements. And oh, by the way, the insurance is getting too expensive, so you quit. Yep, older, more. Male versus female. Smoker. Man, that's pretty drastic. So, different ways to keep the payments the same. They can say, oh, it's $40 a month from here on out, but the amount of money that you'll get if you die is going to become less. Or they could say, it's $40 now, but every year it's going to go up by, a few bucks so that it gets more expensive as you get, your propensity for dying goes up. Mortgage life insurance, you'll also see this on credit life insurance. This is not a bad product. They'll make it sound like, man, they are just the most magnanimous, they're just thinking of you, and they want to give you a life insurance policy, as a benefit with your mortgage. First off, you're paying for it. It's in the mortgage. Second off, they're the ones they're going to have to, in the event of your death, they're going to have to come out there with your grieving spouse and, wrestle over trying to get payments and stuff. They would rather you have a dedicated life insurance policy tied to that mortgage so that the house is paid off. They get their money, the loan's settled out, your spouse is doing well because that house is paid off because you have this small life insurance policy. So you'll see this on mortgages, you'll see it on credit cards too. They'll call it credit life insurance, a free policy for you. Yeah, nothing's free, and but it really makes their life easier and yours as well. But they're just not always as upfront about that. Group policy, just like health policy. If you can get life insurance through your work, sometimes it's cheaper. Okay, so now we start getting into these other products that are hybrid products. Whole life insurance, permanent insurance. It's like, what does that mean? So now, that's where the agent steps in. And this is where he gets his commission. And he explains it to you that, also has a cash value and it's a hybrid investment. Fair enough. But it's not going to be $40 a month for $1 million coverage. It's going to be like $800 a month. So, again, same factors. Yep, your health and the rest of that forms a whole life. Some of these you get fully paid where you get older and now you've got so much money invested where your payments actually stop and you have this life insurance policy that follows you around. But again, if you would have put that in a pure investment, you might have been better shape. But that's on you. You have to have the discipline to have done that. Comparison in term, higher premiums significantly. Accumulates. It has a cash value. Premiums remain constant because that cash value is building up. Universal. So again, what universal? It's kind of nebulous term. Insurance over specified term, savings, variable. What they came up with variable. People were saying, okay, you're not getting the same, the same investment value. My policies, if it's an investment, it's not getting the same yield other folks are. So, they're looking at different types of investments, higher yield investments, stock market type things that may have more risk, but maybe have a higher yield. So again, you can just tell by the nature of the terms, kind of vague, kind of whatever, not term. How much do you need? So I don't like this method, I'll tell you right up front. Income method, it has no bearing to anything. So I would not use this. Not at all. Let's say there's a single guy, he's making $100,000. So he used this, in their case, $40,000. Needs $400,000. How many kids does he have? Or she, whatever. Are there kids involved? Is there a house? Do you have like a stay-at-home spouse? Do you have, some other? There's no personalization to it. It's just too easy, but too simple. It doesn't work. Budget method based upon the expected future expenses. So, yeah, annual living expenses, special future expenses, college, things like that. Debt. Do you have a lot of debt out there? Did your spouse, work some regular job to put you through school and doesn't have a college degree? Although the trades are paying pretty well. Don't forget that. But if let's just say an unskilled spouse, it's, they might have put themselves at a disadvantage that it's going to make it tougher for them to have that same level lifestyle that you are looking for and value of existing savings. Yeah, if you've got a ton of money, there's a lot more variables. So it's not just a multiplication of your income. It's actually taking into account some specialty things. Using the internet. The internet's not a magic thing. I mean, the internet may organize the factors for you. And but you'll see that when we talk about the project. There's all sorts of, in the brokerage companies, they want to be your one source for everything. So you can go in there and get all sorts of life insurance advice. That's not their primary goal, but they do want to keep you, if you want it, they want to help you with it. They want you to have kind of a single company. Limitations in estimating need. Yep, major illness and disability. Yep, a lot of things. Debt level. So a lot of variables. You want to maybe figure out what you're going to need. But, you figure, okay, I've got a mortgage, 400 grand outstanding on the loan, 2 kids, give them each $100,000 for college. I realize that's maybe more generous than some of your parents did, but whatever. We're trying to be benevolent here since you're not going to be around. And whatever, you come up with some number and you say, I need $1 million. That would provide a cushion to my children and my spouse, and bada bing. You find a company. Yeah. Most of these things, when you go on a regular life insurance one, they're just like the mortgage, or not the mortgage, but the brokerage firms. They want to kind of guide you towards products that they sell that involve commissions. So, might not be the best way. Needs and dreams. I don't know why they're bringing this up in this section here, but I think you can usually, if you're in good health and you're young and you get term life insurance, you can usually get enough insurance to cover both needs and dreams. I found it pretty affordable. And, the peace of mind of knowing if something bad happens, the family's going to be taken care of. Beneficiary is that person who's going to get the policy, Grace period, different things in the legal constraints where, for some reason you miss a few payments, they can't cancel you immediately. They have to. Grace period can be used in a number of different ways, but generally I've seen it where if there's a missed payment or two, they can't just, cancel it. Living benefits, this is kind of cool. Let's say, very bad, you're terminal brain cancer, you're sure to die, but the family's sort of struggling along right up here until the death. How about, I've got $1 million policy. How about you, kick loose with a few $100,000 so that me and the family, the family can stay in a hotel near the hospital for that last month or so, or maybe we take a trip before something. So anyway, it's a way of when somebody is judged terminal, that perhaps some of that money can be forwarded to them before they actually pass away. So again, kind of grim stuff to talk about, but could make a huge difference. Non-forfeiture clause, so this gets back to whole life policies. A lot of fine print in here, but since it's a whole life policy, you will have your salesperson, make them earn their money. Loans against it, not on a term life, there is no cash value. Incontestability clause, there's typically something in here where if something was screwed up in the paperwork, or they said, oh, you didn't tell us about whatever, after a year or two, they can't fight it over those sorts of things. They can't say, oh, you had an undisclosed illness and whatever. After a certain time, they can't contest it. Renewability option. In a term policy, you may have something that says, it can be extended, which would be nice if you need it. Conversion policy, oh, they'll definitely want that. Term and the whole life. Effect for the rest of your life. And there's, that's going to be the pitch that, oh man, term, you won't have it when you're older. You'll have no insurance, no life insurance. I'm not losing a bit of sleep over it. Settlement options. So the beneficiary, how they're going to be paid out, lump sum, payments, how that's going to work. Oh, there we go. Lump sum, installments. Interest payments, settlements. Okay, so different ways of getting the beneficiary the money. Selecting the life insurance company. Should be a company you've heard of, but the big deal is AM Best. Most of us don't do much in the way of insurance on a daily basis, and you think, oh man, that's a good company. That's the one my dad had. That's a great company. Well, is it the same company? Has it been bought, sold? What you want to do, in most financial situations, you'll find these sort of third-party companies. In the insurance business, it's AM Best. In the financial business, it's, Standard & Poor's or Fitch or whatever. Different companies, third parties that are not, involved in the process, and their job is to do ratings. Look at the financial solvency of the company, whether they're, good, and that's where they make their money. So it should be a company that you've heard of. Sounds like a good company, but definitely make sure that they're accredited. All righty, so that is life insurance. You'll watch a video, and in this video, I guess some of my videos are getting kind of dated, but there's a lady who used to be quite popular in personal finance stuff, Suze Orman or Susie. Anyway, but definitely, I don't think you're going to find too many people who are independent, who are not salespeople, advocating, outside of the company, who are advocating for anything but term life. So I don't agree with some of these Dave Ramsey and some of these other financial guys on a lot of things, but I think I would almost use that as a guide for the quality of the financial advice you're getting from somebody. If they recommend something other than term life, they may not have your best interest at heart. Okay, investing fundamentals. So we're actually kind of changing phases here. I guess this is going to be a long lecture tonight. Investing fundamentals. So we won't spend a whole lot of time. We're just going to do kind of a quick overview, but kind of know where you're at. If you've got credit card debt, you're not investing. You need to pay off the credit card debt. I mean, man, you can make a lot of money investing. You can do quite well, but you're never going to get to the 20-some%. I mean, there are people who, we don't talk about. We don't talk about the losers. They'll talk about the winners, the people who, maxed out their credit cards and bought crypto and got better than the interest rates on the credit cards. But that's very few and far between. The people who lost, who got wrecked, they're not sharing those stories. They just kind of crawl off and suck it up. So pay off your loans, pay off your credit cards, and I'm talking high interest loans, not necessarily a mortgage, because a mortgage is an investment. Even though you're investing, maybe pay your liabilities first, makes more sense. Yeah, don't run yourself down. But again, you're maybe not giving up all your liquidity, because different investments don't necessarily crush your liquidity. You can put in quite a few investments. Investments in the stock market are quite liquid. You can get that money back in a couple, 3 days. Now, the wisdom of selling it, liquidity doesn't quite address that. So generally, it's viewed that younger folks should be more aggressive, because in the long term, the stock market tends to get around 10%, but that's the long term. There's, some years where it's not that, less or even negative, and other years where it's double that, and so it evens out over time. If you're somebody who's nearing retirement and doesn't have much in the way of savings and is living, off of their investments, probably not the time to be speculating. So when you're young, though, it's kind of time to sort of go for it. And again, within reason. Investing. There's different things. There's investing, and then there's speculating and other things. Investing is fairly, not conservative, but it's not. Speculating is just short of gambling. And so I would not. I mean, there are speculative investments in the stock market, but for the most part, it's investing. Depends what the underlying security is. Money market securities, so those are just government issued things, very safe, but very low yield. Then stocks. Common versus preferred stock. Don't get wrapped up about this. Not such a big deal. There's different types of stocks. some companies will pay a dividend. Other companies will not. They'll reinvest their profits. So you can get in arguments about whether you want to. Generally, a company that pays a dividend is considered an income stock, and a company that's reinvesting their profits for growth is called a growth, or different terms for them. Now, companies that do happen to pay a dividend can be divided sometimes. Sometimes they'll have common stock and they'll have preferred stock. And all this means is a company that's typically paying a dividend, if times are hard, they may not be able to pay a dividend. If they get in that situation, then only the people with the preferred stock are going to get the dividend, and the just regular common stockholders are not. The reason why I don't worry about this one bit is if a company's struggling and not paying a dividend, I don't want any part of that company. And plus, I don't want any part of income. I'm whatever. I'm still more into growth companies. Most of these companies that pay dividends are larger. I wouldn't say stagnant, but they're not having the same growth as the growth stocks. So very rarely do I get a dividend. And so this whole thing about common preferred, I do not care. Primary and secondary markets. So what happens is there's different things here. We're going to talk about stocks and bonds. And a stock, when you're buying stock in a company, you're buying an equity. You're buying an ownership position, right? When you're buying a bond, a company, big companies don't, loan money, get money from banks generally. Banks don't have those kind of resources. Commercial banks are more, they orchestrate, lenders, but they don't have necessarily the resources to be making direct loans. Normally, if a big company wants a loan, they'll have a bond issued. And then you, as the investor, say you buy a bond, and what you do in this case is you give, say, this company $20,000, and then they give you a payment of say 5% per year for 20 years, and then at the end of that 20 years, they give you your $20,000 back, and that's how it's a loan to them. You don't own the company. You don't have any position. You don't get to vote with the company. You don't get to do anything. But if the company goes out of business, you are have some recourse, because they should settle up whatever assets and repay the loan. Conversely, if you own stock in a company, you own a chunk of that company. The company will, if it's publicly traded, they will issue stock, people buy the stock, and people buy a small chunk of that company. If the company goes out of business, you have no recourse. You're an owner of that company. That was your company that went out of business. You're not going to, try to seek money back from yourself. You're in on the game, so you're part of it. Now, where they get involved here with primary and secondary markets is just about all the stock you buy. Let's say you want to buy some NVIDIA, popular company now. They do a lot of, they started out with graphics cards mainly, and then they got Bitcoin miners used them a lot, and now AI is using them a lot. So it's a great company. I've had it for years, and they're doing quite well. But anyway, if you go to buy some NVIDIA stock today, you're going to be buying it on the secondary market. You're going to be buying it from shares that are already out there being traded. If you happen to work for NVIDIA, maybe you contacted NVIDIA directly and you wanted to buy the stock, you could do that. Or if it was the IPO, the initial public offering, maybe you could get it, somehow get it directly from the company. IPOs are a strange thing, and for small-time investors, retail investors, we usually get screwed. But anyway, different thing. But anyway, so the primary market would be buying directly from the company. Secondary market is, you go on whatever brokerage and you buy some stock, and that's secondary stock. So, anyway. I used to have a thing where I worked for a company. I didn't like the company, and but they had an employee stock purchase program, so I was buying primary shares directly from them, and they sold them to me at a 5% discount, and so I did that the max extent possible, and then I would get those shares and I'd sell them as soon as possible. You know, as soon as they put those shares into my account, I paid for them, and I would sell them the next day. And in my mind, you know, it was a little bit of extra money for me because I bought them at 5% discount and obviously sold them at full price. So the reason why you want to do that, even if you like the company, let's say you work for General Motors and you happen to have your livelihood is tied to this company, and now your investments are tied to this company, your pension's tied to this company, I'd want diversification. I would want to sell those stocks and be holding something else, so I don't have everything wrapped up in the health of a single company like General Motors. Anyway, types of investors. So institutional investors, these are people, let's say, it's coming up on PFD time, the permanent fund. State of Alaska, what they've done is they got the money back from the oil revenue, and then they essentially have a fund, like a mutual fund, where the state of Alaska has an institution where they will buy, and they've got a lot of commercial property, which is not a great thing in this market. But let's say you've got the the pension fund of the teachers union. You've got all these different big organizations that have funds available for a lot of it's unions, a lot of it's retirement plans, state retirement plans. So anyway, a number of things are institutional investors. Then you have portfolio managers. These guys are typically, let's say you have a big mutual fund that we'll talk about later in the thing. Mutual fund's like a collection of stocks that might be put in a single portfolio, and the person who runs that is buying stocks and things like that. So that's a portfolio manager. And then an individual investor, that's typically you and I. That's a retail investor. Day traders, that's a whole different thing. That's a trader. So not really it's a category, but it's not. These are people who it's not. We'll talk more about that, but not necessarily a big deal. So you as say going through your financial life, you might find yourself in kind of all these different categories. You may be individually buying and selling stocks. You also may work for a company that has a retirement plan that is an institutional investor, or you're in the state of Alaska and you're in the PFD, so you have some representation as an institutional investor in that thing. And then through your company, let's say you're buying 401k and they want you a 401k program, and they want you to invest in a certain selection of mutual funds. So those mutual funds are managed by a portfolio manager. So you'll have basically exposure across all of these areas. So I talked about what bond is. It's just a loan, basically, right? Long-term debt security. Government or corporation. So private money or government money. It may be a school bond. It may be a bond for a bridge or something like that. Or it may be a corporation that wants to borrow money but doesn't want to sell more stock. Mutual funds. So that portfolio manager, a mutual fund, let's say you're big, you think AI is going to do great things. But you're like, man, I've got all my money in a single company, NVIDIA, which is not a bad way to go, by the way. But anyway, let's say you're like, I don't know, there's other companies out there. I know AI is going to come along, and I think NVIDIA is going to be in the lead, but I'd be more comfortable, and you would be probably smarter financially, to have some diversification. So these guys are involved in a couple different chip makers, and maybe AMD, another chip maker, and all that, a whole group of people. And so in order to get that diversification, Now you don't necessarily have to pick the exact winner. You can pick sort of the winning sector. And so it's an easier way to do it. Buying stocks used to be more difficult. We'll have a whole separate lecture on that. You had to have a broker and you had to buy in whole shares, and it was just difficult. Mutual funds have always been easy to buy, and they do a lot of that, and they have, this portfolio manager who kind of knows when to buy and sell, and again, I'm not. I like to invest in individual stocks personally, but most people have a life to live. They have other responsibilities, their job, their kids, their whatever, and you're probably better off doing a mutual funds. Mutual funds can be what I described was a sector fund. You could do, it could be a geographical thing. You could be, for some reason you think Vietnam's like the next big thing. You could find a mutual fund out there that invests in that. You could have, I'm very concerned about some ethical concern, and I still want to be a good capitalist, but I don't want any companies that are doing this or that. You can find a mutual fund that will do that. You can find a mutual fund that's going to be very conservative. You can find some that are going to do crazy stuff with your money, whatever. There's a lot involved in it. To say mutual funds are risky or safe or whatever. It depends what the underlying assets are. There are mutual funds that do all of that. Anyway, so types of investments. They talked about bonds. I'm not a big fan of bonds. They don't yield as much, and I'm more into. I've had mutual funds. Obviously, you have to do that if you're working for somebody. They generally won't let you involved in direct stocks most of the time. Indexes. We'll talk more about this, but indexes are that portfolio manager when they're buying and selling, and a lot of times they don't do that good a job. Sometimes you could have just bought into the whole, index, the stock index, the Standard & Poor's or something like that, and done just as well and not had to, number one, pay for this high-powered portfolio manager and not pay for all his commissions and everything else he's done with all the trouble. And then real estate, obviously a great investment. I find personally that real estate is a good investment, but it's very solid. I don't go into real estate to make a ton of money. I try to do quite aggressive things in the stock market, but oh my God, you don't want to be involved in that day to day, for years and years, because good companies come and go, and it can be a lot of work. A lot of times, if I make money in the market, I will prefer to buy real estate, and then it's much more secure. So, investing in a stock, you own a portion of that company, and this gets back to that discussion I was having about dividends and price appreciation. So, growth companies, the stock price is going to go, just like in our test example, went from 35 to 50 or whatever. So that was price appreciation. Now, if it was a more mature company, maybe it went from 40 to 45. But, oh, by the way, you got a dividend every, month or every year. And so you made a little money that way. So it's a trade-off. But companies that pay dividends, they're typically more established companies. Companies that work more off price appreciation, they're usually companies that are expanding and when they have profits, they're not paying them back out to the shareholders. They're using them to grow. They're buying plants and equipment and all that stuff. So growth stocks, substantial growth, income stocks provide dividends. So, coupon payments are what they call those things, the payments you get with your bond. Bond appreciation or depreciation. Bonds are dependent upon the prevailing interest rate. Mutual funds, it's nothing but the underlying assets. If the underlying assets do well, then they aggregate those together, and that's how the price goes up and down. It's just a lot more math involved. Rather than the stock price, they'll normally call it a NAV, a net asset value, where they combine them all together. In real estate, dead easy. Either rental income, price appreciation. So again, typically I have raw land. It's a lot easier. You don't have to deal with tenants, but there's no rental income. It's strictly a price appreciation thing. Although, I mean, I do have a couple homes, but anyway. They're going to try and make it more complex than, try and introduce some math to make it a lot. You don't worry about the formulas. This is all very common sense. They try to, wow themselves with making it a little bit more complex than it needs to be. The amount of money, the return, that's how much you're going to get. This is what you paid for it, and this is what you sold it for. So, yeah, I sold it, sold it for $100, paid $50. Ooh, I made 100% return, right? Doubled my money. Dividend, same thing, but there's a dividend. So if they say, how much money did you make? You bought the stock for 40, you sold it for 45, but oh, by the way, you got the equivalent of like $1 a year in dividends. Then you would add that dividend in there, and then the original price is always going to be down here on the bottom. Again, don't get wrapped up with the formula. You don't need to memorize any of this, because it's just complete common sense. Differing tax rates on return. So interest payments and coupon payments taxed. So on the W-2, or not W-2, but 1040, you're going to, pay on those normally. This on capital gains investments. So remember how short-term, long-term, I said it's always going to be 1 year. So capital gains held 1 year or less, they're just going to be added to your income. So if you're in a 28% tax bracket, you're paying 28% on those capital gains. If you hold them for more than a year, then boom, you're down to 15%. So that's like, they always say, oh, Warren Buffett's secretary, she pays so much more in taxes than Warren Buffett does as a percentage. That's because Warren Buffett keeps his stuff over a year. He's not living off a paycheck. He's living off his investment, so he's going to get taxed at 15%. And the poor secretary, she's got ordinary income, so she's paying whatever the prevailing rate is. So there, there's a little more to it, but yeah, and investors have already, they got that money from somewhere. They might have been earned income at one point, so they got taxed on it once already. And now they're investing it, they're going to get taxed on it again. So, different ways you can think about it. So, here's an example of short and long-term capital gains. So, again, you have to do kind of a gut check. Getting back to the crypto stuff, I mean, I'm up hundreds of percent on some of these investments. Do I want to keep them a year? Oof. It's kind of sketchy because, and don't get me wrong, if you're involved in crypto, 10% is probably the rule. 10% of your investments. Don't go all in. Don't use leverage. Don't be borrowing money to do any of this. And maybe you're too late. There's a concept called FOMO, fear of missing out. Essentially most crypto is, I love it, but it's also a Ponzi scheme, meaning that the people that jump in at the last minute are the ones that make the money. I mean, if I'm making 100%, 200%, somebody else is losing that money. The money didn't just come from, the internet magic money. There is a source of that magic money, and it's the person on the other side making bad decisions. So don't be one of those people. But it does go cyclical, so another 4 years from now you'll have a chance to get in. But it may be too late in the cycle. So anyway. So tax rates, yeah. If you can keep it over a year, your tax rate's going to be considerably lower. Measuring investments risks. So on any type of return, there's a lot of, when we get into traders and speculators and things like that, there are so many people who their calling was in physics or math or whatever, and yeah, they had some prestige as a college professor, maybe made a decent salary, and they got into the market and they applied those skills, and that's where a lot of those returns come from. But anyway, if you're just looking at an investment, big picture is you want to make sure that your return is commensurate with the risk you're taking. If you're getting a very small return, then there should be very little risk. If you're getting 20% return, but there's no risk involved, you're in a Ponzi scheme, or you're not aware of the risk that you're being exposed to. Famous guy a few years back, Bernie Madoff. These people were getting 20% year after year with no risk, virtually no risk. And all it was a Ponzi scheme. People were coming in and they weren't really investing the money. Madoff wasn't. He was just giving the new money that was being invested to the old money, and this all works until, the wheels come off the bus, and then finally, where are all the investments? There weren't any investments. It was just a scam. But these people said, well, I didn't ask any questions. Well, but it's nonsensical. You cannot get 20% return year after year without taking any risk. They took exceeding amount of risk. They just didn't know it. So anyway, small firms tend to have more growth potential but higher risk. Yeah, IPOs have higher returns. So, yeah, I'm reading a book, or I've read a few books on this. But Peter Thiel, genius kind of guy, PayPal, Palantir, all kinds of other things. But he's one of these venture capitalists, and you look at some of the profits, some of the returns they get on some of these companies, astronomical, thousands of percent. But 9 out of 10 of these startups fail. So again, if these venture capital firms, they don't invest in a single company, they invest in a whole bunch of companies, and 9 out of 10 of those are going to go to zero. But that one winner, is going to be the Facebook, the eBay, the PayPal, and it's going to go to the moon. And people go, oh, that's unethical that this guy just made that kind of money on a single company. What they don't talk about is the other 9 companies that just tubed. So, anyway, risk and return among bonds. Bonds, that if you're getting a high rate of return on a bond, it's because the company's got some risk to it. And bonds, we'll look at how they're graded and all the rest of that. But basically, a bond is, if they're trying to sell it to you, they'll call it a high yield bond. If they're evaluating it, it'll be the same bond, but they'll call it a junk bond, because it means that company, the reason why they're paying you, 15% interest on their bond is because they're probably not going to be paying it for very long, because the company's going down the tubes. So you need to know, what's going on, and again, what the risk is involved. Mutual funds, same as stocks. All kinds of different mutual funds. Again, third-party agency that reviews mutual funds, Morningstar, we can look at that. I think this is going to be kind of a long lecture, so I'm probably not going to go into too much more detail. We'll catch up on it in the following weeks, because we're going to spend more time on each one of these subjects individually. Renters could default. I have a tenant right now who thinks that the 10th of the month is like the first of the month. I've never experienced this before. He pays every month, but oh my God. And I always have to send him a text. Rent, ? And yeah. So I'm fully aware of deadbeat tenants. Property value could decline, certainly. You need to choose wisely when you're looking for a rental property. Different types of investments, yep, suit your style. You need to be realistic. Borrowing to invest, nope. for stocks, even more so for crypto, complete suicide. That's called leverage. It's margin calls. So we'll go into details on that, but pretty scary stuff. But real estate, it's just the way it's done because it's not as risky of investment. So I would borrow to invest in real estate, but I borrow to invest in stocks. So it's doubling up to catch up, taking risks to recover losses. So that's gambling kind of behavior. That's not going to end well. And then the term project. This is all in the syllabus. So quickly though, I just want to go to one last thing. So there's no homework on here this week because you probably should start looking at the term project. So when I was talking about the price of term insurance, so here's a $26 a month, $500,000 for a 40-year-old, which is getting a little older, with a 20-year. So anyway, it can be done. This is just nerd wallet, but anyway, those types of policies are out there. If this was any sort of complex whole life, whatever, you're probably pushing 1,000 by now. Okay, I'm not recommending any, companies right off, but and I don't want to jump into my Fidelity stuff. I don't think they've got my password saved. Anyway, I can't spell Fidelity tonight. They'll figure it out. So Fidelity is a company. There's Vanguard, T. Rowe Price. It doesn't matter. They're all good big companies. But what I want to show you are just some of the resources that are out there. Now, you don't have to open an account. You don't have to provide these guys your email. You don't have to do any of that. But if you're a student trying to figure out how to complete this term project and answer all these kind of strange questions about how you're going to do things, there's a lot of things in here that will help you out. Life insurance, long-term care planning. These are topics we've talked about that if you can go through and kind of glean some knowledge off of this, maybe even a graphic or two, you can make your term project pretty good. Now, okay, so they do have universal life, so they may steer you that direction. But term life, they're ready to give you a quote right now because they can do that because it's pretty easy. Anyway, here's another explanation. You can make sure I'm honest with what I gave you. The problem is term life means term life. That's fairly universal. Whole life, universal life, different types of other things. Now we start getting into marketing terms. But here's some of the things they'll set up for you. But anyway, since they do sell all the products, the smart money, if you're a big company, is to kind of scare you to the more expensive products. But you'll have to read through and see what's going on. So anyway, you have a lot of different things. They even sell crypto now. They want to be your kind of one-stop shopping. And so in terms of equal time, Vanguard, another big one. You're going to see different... I shouldn't have clicked on that one. Anyway, same sort of splashy website, all kinds of stuff. And, here's some of the different investors. So they haven't even put you into a specific category just yet. Again, resources and education, maybe something you want to talk. Personal finance. So there's just a lot of good free information out here. And these guys are big enough to where they're not going to be so scammy. And you, as a young person not associated with a big company, are prime for them. They're going to provide you all sorts of resources. So they want to develop customer for life. T. Rowe Price. Maybe they're owned by Schwab now, maybe not. Schwab's another big company. So any one of these companies is going to be just fine, that you choose. Usually, wherever you're working, they may be associated with a certain company, and you may, end up, just for simplification, going with that company. But these big companies, generally they're located on the East Coast, but they just have a lot of resources, and they get the kind of returns that you're kind of after. And here's a 529 plan that should be part of your, if you're saving for college, this is going to be tax deferred, growing retirement savings. I mean, just all sorts of information. So I'm not going to recommend one specifically, and there's probably, I'd say 8 or 10 just mega companies. In fact, we can look at Evil BlackRock. I don't have anything. Well, I probably do. I just don't know it. I don't deal with BlackRock directly, but they've got sort of a branding problem. But yeah, too much stuff. Anyway, same sorts of stuff. Mutual funds. And most of these companies, too, you can buy not just their own mutual funds, but you can buy the competition's mutual funds. Because, again, they want to be your one-stop shop. They don't want you, going off and looking at different companies. They're going to put their own stuff in first. That iShares stuff is their own. But they will make it quite easy. There's actually more mutual funds than there are individual companies, but you can get down in the weeds. You can find, what type of exact fund do you want, and it's probably out here. And if they're any good, there's going to be some sort of Morningstar ranking on it, because they know people don't trust these companies directly, and they want to see, what Morningstar thinks about it. So anyway, these guys don't seem to have the Morningstar ratings as much. Sustainable funds, you can pick what you want, markets and regions, asset class, just so many options. So anyway, I think we've done enough for tonight. We'll talk more about this later on. If you did have a problem with one of the questions, let me know, and we'll get over. Golly, an hour 37. My apologies. I'm done. Good night.